Before the Federal Reserve was established in 1913, the U.S. banking system was highly decentralized. Previous attempts at creating a central bank had failed, largely from resistance among some members of the government who were concerned about the power of a fully centralized banking system. But the lack of any central bank left the country with a fragmented network of mostly state-chartered banks instead, with many issuing their own private currency in exchange for deposits. This led to localized liquidity issues as banks across the country often refused to accept each other's notes at full value. These banknotes were also easier to counterfeit and could become worthless if the issuing bank were to collapse. The government fixed this issue of a fragmented currency supply by taxing state-chartered banknotes, effectively disincentivizing banks from issuing them. This boosted the demand for national banknotes issued by federally regulated banks, creating a more uniform currency. But despite this success in consolidating the money supply, the absence of a central banking authority still left the system vulnerable to a series of bank runs and financial crises, like the ones in 1873, 1884, 90, 92, and then 1907. The Panic of 1907 in particular revealed a critical flaw. When banks started to collapse, financial institutions and clearinghouses often needed to organize emergency funding as a last resort to stabilize the system. But if a formal lender of last resort were created, it might prevent future panics and restore public confidence in the banking system. In response, the idea of a central bank was revisited, leading to the Federal Reserve Act in 1913. Similar to compromises made on the structure of the country itself, the proposed Federal Reserve model was designed as a compromise between full centralization on one hand and the previous decentralized free banking model on the other. To accomplish this, its structure was divided into three main components. First, a board of governors with members appointed by the president who would oversee the entire system. Then 12 regional banks, all in different U.S. cities, which would divide the country into Federal Reserve districts. And lastly, a Federal Open Market Committee, or FOMC, composed of all 7 members of the Board of Governors and 5 rotating regional bank presidents, who would determine monetary policy. With the creation of these regional reserve banks, private banks became members in their respective districts. Member banks were required to then hold reserves at their regional reserve bank and could also borrow additional funds from them through a lending facility called the discount window. This mechanism allowed for the flexibility needed for private banks to maintain liquidity. But over time, relying on the discount window became a negative signal that a bank was distressed. So instead, banks began trading excess reserves with each other in what became known as the federal funds market. The interest rate in this market, determined by the supply and demand of funds among private banks, was effectively the core interest rate in the economy, since it would influence the rate that banks would charge on loans and then by extension the supply of credit in the broader economy. So initially created to address financial instability, the Federal Reserve's responsibilities have since broadened over time. And while its core structure remains unchanged, the modern Fed not only acts to stabilize the banking system, but also proactively implements monetary policy under a dual mandate established by Congress of ensuring both maximum employment levels and stabilizing prices in the economy. To do this, the modern-day Fed deploys 2 primary classes of tools: interest rate targeting and open market operations. To achieve a target interest rate, the Fed focuses back on that same federal funds market and sets a target range it wants the market to trade within. How it does this in practice has evolved over time, which we'll cover in a different video, but regardless of the mechanism, the idea is that by targeting a range for the federal funds rate, the Fed can indirectly influence broader interest rates and the supply of credit in the economy. On the other hand, the Fed also directly influences the economy through its second monetary policy tool of open market operations. In this mechanism, the Fed buys and sells U.S. Treasuries in the open market, typically from large banks. When it buys Treasuries, it credits the reserve accounts of those banks, increasing liquidity in the financial system. In the opposite case, the Fed can sell Treasuries back in, effectively pulling liquidity out of the system. Through both of these policy tools of targeting a range for the federal funds rate and adjusting the supply of liquidity among financial institutions, the Fed exerts a huge amount of influence on the current financial system and the broader economy. If you found this video helpful, don't forget to like and subscribe and press the bell for notifications.